Of Peak Market Watch. We speak with market leaders in commercial real estate and related services who have a close pulse on the current market environment. My name is Anton Madley, co-founder and CEO of Peak Financing, and I'm honored to welcome Kevin Day, who is a partner at Tresp Day and Associates, a firm that specializes in estate planning and asset protection law. Welcome, Kevin. It's a pleasure to have you with us.
Anton, thank you for having me on. It's always good talking with you.
Yeah, definitely. So we know each other now for quite some time, right? We are actively involved with real estate guys and their students and clients. So we got to know each other over the number of years now. And it's what you're doing is might be not on the radar for a lot of people, but I would say it's a very important aspect of what investors should consider, and anyone who has a reasonable amount of assets. But rather than me rattling on what you could potentially do, why don't you tell us a little bit more about yourself as well as your firm?
Yes, my subject, well, I think it's exciting, but for an entrepreneur, lawsuit protection and privacy planning isn't usually top of the list because it's not the fun part. It's not going after the next real estate deal or figuring out the puzzle of growth that they're going through, whether they're just accumulating income generating single family residences or whether they're doing very complex syndications or investing in syndications. All that stuff is very exciting and motivates the investor. What we do is, on the other side, not making the wealth, but making sure the client can keep the wealth. And it's unfortunately, we get calls, every week. I just got a call this morning from a woman, not a large estate. She had 2 apartment complexes in her own name, which wasn't the issue because it wasn't a boiler that blew up. It was, she was inching out into a very blind, the bushes were there. So she was inching out into a street that have a stop, and a motorcycle came zipping along and hit the front of her hood. There were witnesses that said that she was being very cautious and everything, but she was there. And, the motorcycle was probably going too quickly. There was hedges that were up, but she's the one that has to prove herself out of that bag. And they're going to come down the ownership chain, whether it was in an LLC or not, to take, her wealth. So it can be very simple doing, just because we're good people doesn't mean bad things can't happen in our legal system.
Yeah, it's a very good point, right? It's unfortunate that happens. And obviously we live in a very litigious environment, particularly in the United States, right? I'm from Switzerland, right? In Europe, it's not as common for people to sue there. Whereas, as I've learned myself in the US, it's very easy to file a lawsuit, right? And if anyone has a view, well, maybe there are some assets that it can go after, it's pretty easy to file a lawsuit, right? Yes. And it's unfortunately for the individual that then has to defend him or herself, it can become very costly. So it makes sense to start out on the best foot, and obviously to protect your assets as much as you can. You cannot stop the lawsuits, but the less someone feels that one has assets that can easily be attacked, the less likely it obviously is that someone will ever consider to file a lawsuit.
Exactly. Yeah, we have 94% of the world's lawsuits in the United States. It's become such an industry. It's crazy. And as you're mentioning, privacy in and of itself is not lawsuit protection, but it goes so hand in hand with lawsuit proofing in a state, lowering your profile so that somebody can't just type in and see, oh, you own, 4 apartment buildings and there's only a lien of such and such. We know how much equity they have. Yeah, this is good lawsuit. Let's full steam ahead.
Yeah. So what are some of the structures that you recommend for, depending on obviously where someone is in terms of assets, as well as in terms of activities that they have. I would think that it's a different story whether someone is a W-2 employee compared to someone who is an active real estate investor, and may also just someone who is just investing in someone else's deals.
Yes, we have the whole gamut, which is exciting. Our firm is in the top 2 in the country regarding offshore asset protection, offshore protection trusts particularly. Those were approved in the late 1980s. That was the first time ever once we signed the Hague Convention on Trust, where U.S. persons could establish a trust under other countries' trust laws, even if they were diametrically opposed to the U.S. trust law, and it was still the law of the land in the United States, and under U.S. law removes U.S. court jurisdiction. That's really powerful. Certainly, we have that at one end for larger estates or medium estates that have super high risk. But down at the other end, the typical answer, going to a corporate lawyer, real estate lawyer, or an estate planning lawyer, and you ask, I want lawsuit protection. They say, how many properties do you have? Oh, you need 7 LLCs. And that's conventionally that is sound, putting eggs in different baskets, but there's so much more that can be done by a true lawsuit protection expert, so that you don't even lose the equity in a particular property, even though that property harms someone. Or in the example that this woman that called us this morning, that it has nothing to do with what's in that LLC. They're suing you personally, and they're coming down the ownership chain. And so there's so many different things that can be used. And we have domestic copycat trusts now, starting in '97, that copy the Hague Convention Trust, where you can name yourself as your beneficiary, but you're not the legal owner, and we can prove that. They're very powerful mechanisms. Somebody certainly that's in syndication, where you're taking other people's money, you have SEC regulation liability, besides the normal market liability and the project liability. Those people really should seriously consider the offshore card, because it's so powerful. But if you're, let's say, a W-2 wage earner who is making good money and now has disposable income, and they're starting to invest in other people's syndication, they want privacy. They should start to consider probably the domestic forms of lawsuit protection trust, but they don't need that big of a hammer as the offshore version. And then at a pure minimum, as we were talking earlier before we got started, a passive investor in syndication certainly should have at least an LLC to make that investment. The passive investment is cash. That's zero liability. However, you're giving your name into the public record that you're a high, margin investor, and you then become a target to the underbelly of our society. If you're going in for a tax position, so you're coming in as a general partner, you have full liability for that project. You have great upside on the wealth side and the tax treatment, but the liability is very high, and you feel very removed because you didn't make the project. You're not the syndicator, but as general partner, you have heightened liability. So you want a heightened lawsuit protection plan.
Mm-hmm. That's a very important point, right? Because we see quite a bit of syndications where you have you can call them the lead sponsors, or the key principals in a deal, whatever it might be, right? So the ones that might be the most visible, the ones that find the deal, that are running primarily with the deal, but very often they bring in some other partners that you have mentioned, or GPs, or the general partners that may play a minor role in the deal, but they are still general partners, right? Mm-hmm. And so it's a good point that they recognize that they are visible, right, and they're also exposed to these risks. They may not be exposed to the as a guarantor for a loan necessarily, but obviously we do not talk about just being responsible for on signing on a loan, but we talk about the liability risk and risk of being involved in a lawsuit, right? And I think that's it's a very important point. Even if one has just a small percentage in one particular deal as a GP, one is no longer on the strictly in there as a passive investor, right?
Yes, and I've done the GP route a few times, mm-hmm. and it's worth it, but it always makes, and I have a good asset protection structure in place. It still makes me a little bit nervous, although the reward is definitely worth it. But you just have to be cognizant.
Yeah, it's always a balancing act at the end, right?
Exactly.
Yeah. So when we look at the domestic structures that you can put in place compared to the offshore structures, how do you determine what is when one or the other is more suitable? Do you drive that primarily by asset size, or by income stream, or how do you determine together with your clients which structure would be the most suitable? Because we can assume obviously that the offshore structure is more costly than a domestic structure, right?
Yes, it's about 3 times more expensive. Yeah. We used to really just gauge it on risk, so if you had machines that could take people's arms off, particularly if you had less skilled employees using those machines, we're going to encourage offshore. If somebody has, depending on the industry and lots of employees, then we start, considering offshore. But ultimately, everyone kept on asking what dollar amount, and I avoided answering that for probably 15 years. Mm-hmm. But in reverse engineering, I started noticing, when did our clients choose offshore? And it was around 3.5, certainly by $4 million estates. And I contemplated that, and this is my conclusion, is that about 3.5 million, some people have incredible spending habits, but the majority of people all their creature comforts are taken care of. They've gotten into a better home. They've bought the little bit of a dream car, not just the basic car. And then they start to have disposable income. And that's when they turn around and say, what can make money while I'm not pushing the ball? And they start to get into real estate. But that once you get into that, where you're accumulating disposable income, you start to deploy that extra income and it starts making money, and people realize that they start to grow exponentially. And they also have a cognition that, oh, even if I don't get any more, if I can preserve this, even if I get hit by lightning rods in lawsuit terms, I can have a decent lifestyle. I need to protect this. So at 3.5, people start seriously thinking about it. 4 million and above, they really should seriously consider it. Somebody that's 2 million and below, and we even have small syndicators that are, they're good at finding projects and they've run out of their own money, so they're doing it. But offshore is just too big of a hammer. So 2 million and above, we really don't want to go down that route. Between 2 million and 4 million, that's where we take a lot of time to educate, because is there a super high risk despite probably not a lot of growth? Or somebody said, I was a renter 5 years ago, and now I have my own home and 5 other properties and 4 employees, and I'm growing crazy, but I'm only at 3 million. Well, maybe they should, stretch. Should they? The question is, should they stretch and get the offshore, or should we do a transition or bridge trust, a trust that is a US trust that can move easily offshore in the future, and needs special provisions, because the only way to attack an irrevocable trust, domestically or out in the world, is to allege and prove fraudulent conveyance, that you had a known existing current creditor today. So you don't want to set up a domestic trust where you're the beneficiary, then say, oh, now I want to have an offshore trust, get the asset back as a beneficiary. You can have full distribution back to you, and then you set up a new trust. Well, now you're vulnerable and you're starting a new statute of limitations. Mm-hmm. And so with special provisions, we can have it move, and we'll get the initial settlement as far as fraudulent conveyance. So you might have a trust for 1.5 years and then move to, let's say, Nevis or Cook Islands, or a jurisdiction that has short statute of limitations, and you only have another half a year to get full, complete bar statute of limitations protection.
Yeah, very good point. So I think of very often when I talk to prospective clients about both US as well as particularly offshore asset protection, and we talk about irrevocable trusts, then one of the key questions that comes up, okay, so what about all the depreciation benefits that I'm getting in the US right now? I have it all in a LLC, and I may have it in a living trust, a revocable trust. So everything is a pass-through structure, and I get all the benefits from a tax perspective. I know you are not a CPA, but maybe you still can touch a little bit on that concern, because that is definitely always a concern when we talk about investment types that have that benefit of massive depreciation, like real estate.
Yes, and that is always a concern to clients. We create our structures as disregarded entities, including the offshore trust or the domestic version. We would need to have special instruction from the client to do otherwise, because we presume the clients, when they usually get to us, have already fine-tuned their tax write-offs and carry forwards and their whole machine. And they desperately want the lawsuit protection, but they say, oh, I don't want those kinds of changes in ownership that would cause tax effect. And so 95% of our structures are disregarded. The trusts are grantor trusts. They just happen to be very high-fangled, irrevocable trust, but the grantor trust is a tax term, an IRS term, and the living trust is a grantor trust, and a grantor means the grantor, the person setting up the trust, is going to be tax responsible. Mm-hmm. We can do that with the offshore trust, so we do not mess with any tax, and they will still get their deductions that are very important to the game.
Okay, very good. So that's an excellent point. Another point, as you know, that is also brought up on a regular basis, right, is that lenders, particularly in the commercial real estate field, that they want to see net worth as well as liquidity, right? And as long as it's in someone's name, or if it's in a revocable trust or a structure that is a true pass-through by how anyone in the US will look at it, it's easy, right? Because it just said, well, it's a pass-through and here is my net worth. Mm-hmm. Can you outline that, how you would tackle that once you are in that offshore structure?
Yes. There's several things at play. One is there are several types of ownership. There's technical ownership for lawsuits. And from a lawsuit protection point of view, corporations are separate legal people, but you have to own them. Something has to own them, and it will only end in two ultimate owners: a flesh and blood human. No one owns you, and no one owns an irrevocable trust. And that's why they're lawsuit proof, one of the reasons. But the IRS defines ownership differently, and it really kind of plays back to the definition of a grantor trust. And so it is still part of your estate. It is, and this is where we use Attorney Weasel words, you are the beneficial owner and you are the tax owner. So we can go to banking and say, I do own this LLC and that LLC and this LLC, and you're not perjuring yourself or misleading. But also because it's still in your estate, it's still tax ownership, we can do a consolidated report. So two approaches. One is doing a consolidated report where the CPA and is putting forward, and we can also do attestations that this is the entire estate of the client. And we're not trying to lawsuit proof it from financing. We will make these assets available and we can prove that up to the banker. We've not seen any problems with that. But we also take that approach that I kind of mentioned first, is not really mentioning an irrevocable trust, because sometimes bankers get skittish. We've never had anything not approved, but it might take an extra month to get to the level decision maker in the bank that understands these sorts of things, and that it is, and we can describe the law. But if they're just asking who the beneficial ownership is, we can say all of these LLCs, including the piggy bank that has all the cash, is me, and go forward. And 50% of the time, we don't even have to disclose a trust. If we do disclose a trust, we do consolidated report.
Excellent. You mentioned the estate, right? So what impact would you say does it have on estate planning?
Yes, any any and every trust at its heart is an estate planning tool. So even these asset protection trusts, whether they're offshore or the domestic version, we will do a full interview and intake related to your distribution desires and conditions that we would put in a living trust, for instance. You don't want Billy and Sally to get too much money if you die too early and they're too young. Larger estates particularly, we want divorce proofing provisions that as long as you're keeping my daughter Afia, in my case, happy, then you'll get all this access to the kingdom. But the kingdom is never, that I've built, is not going to be put directly in her name, but kept as sole and separate property, so we can divorce proof the inheritance. Larger estates particularly are very concerned with that. And we can put all that in the trust on the estate planning side.
Yeah. Okay. Very good. What about planning for death? Do you also have some implementations that you need to consider specifically with the offshore structures?
No, we're using professional trustees in those cases, but we can add a U.S. co-trustee, which is the trusted person in the family. Yeah. And we can do that from the onset, but more frequently, it's triggered upon the demise of our client, the person that set up the trust, so that trusted person that would be carrying out the estate plan in a living trust would still be the person that would be called upon to carry out the wrap up of the estate, so to speak.
Yeah. Okay. Very good. A lot of possibilities there, right? But it takes time, right, to set it all up. So what would you say typically from the time that someone recognizes, I think I need to do something, until everything is put in place through you? What would be the typical time frame that one should keep in mind?
Yeah, usually when somebody, as long as they, some entrepreneurs, a few, take the position that I kind of go on my gut instinct. I've been trained over years that usually my first impression is correct, and we've been referred to you by a good source, and we've looked online and you only have good reviews, nothing bad, and I know I need asset protection. Here's my check, go away, make it happen. That does happen regularly enough, but that's not normal. That's not what we would recommend. We are educators. We think it's important. You don't want to go back to law school, but you do need to, one, know that we are the experts that we say we are. We're not going to get our clients in any trouble by leading them down the wrong path. And that the structures that we're recommending do answer the problem that you're concerned with, whether it's privacy, whether it's the estate planning, wealth transfer to heirs, or lawsuit protection. And that we've created something that does answer those and explained it enough that it's comfortable. So that might take a month. Let's say if somebody is referred to us, we'll work with them. We're probably having quite a few meetings, sending extra information and everything so that they can see what we're proposing. Once somebody says yes, and we get a questionnaire on our desk, it takes about 2 weeks for us to get product out. We're very quick. We've seen basic estate plans, a living trust. Somebody tells me, yeah, mine took 3 or 4 months before I got it. And I said, things can happen. We're responsible. We don't want to be responsible. We know what liability is, and lawsuits can happen for no reason. So we get our product out right away. But it usually takes 3 weeks and maybe 4 weeks really to sew everything up and get everything in place.
Yeah. Okay. Very good. So that's not too bad, right? So if everyone is really committed to make the changes, it might be 2 months, right?
Yes, to go through the process of education and product development.
Okay, so once everything is put in place, what would you say is the yearly maintenance? Obviously, there is a cost associated with it, but not really talking about the cost because that's different from in each case depending on an individual structure, but more what an individual's or a family's actual involvement is on a yearly basis after everything is put in place.
Yes, the structuring, many of the things, what we're trying to do is make it not impinge on and be administrative burden, because the clients make money by being out and running their businesses and acquiring new investments and new properties. So even though we might have, let's say, a trust and an underlying piggy bank company and a real estate holding configuration is very common, but the trust goes up on the shelf right away. So you're really only getting one extra company that is completely lawsuit protected, and that becomes our basis. And the client is the manager of that. And being the manager does not weaken the structure at all. The law is very clear that it imputes no ownership being a manager, it's an employee, but that way we can give them back the power. So they have the checkbooks, they decide what they're paying themselves in salary, they buy and sell just as usual. But instead of having a long-term savings account, now they have whatever they end up calling it, Golden Mountain Enterprises checkbook.
Right.
So once it's in place, it's very smooth running. The annual maintenance on an international structure is going to be about $3,500 a year with government registration and annual trustee fees. The domestic equivalent is going to be under $800 a year to maintain. And it can actually go all the way down to about $285.
Yeah.
A year, and that's really the corporate maintenance, not the trust.
Sure. Yeah.
Trust can be in a position to have no annual fees at all.
Yes. Yeah. Okay. So that's not too bad, right? Particularly when you consider particularly active investors and syndicators that have a lot of entity structures, that's not such a significant amount, considering all the maintenance costs that one has for all the domestic LLCs for the various real estate entities, right? So
right.
I think a bigger chunk, certainly, that is also important to consider with all of this from a not necessarily money, but again also work perspective and smoothness of operation is the accounting side. So I assume that you work or recommend, at least for your clients, to work with specific CPAs that really understand the structures that you're recommending, so that the US piece is smoothly and properly integrated with the offshore piece.
Yes, and we have people. Mike Pine is an example,
right.
That you want to, if you have a CPA that's worked with your estate and everything, we will take the time and educate them and make sure that they know what we're dealing with and the forms they need to file and how to make it work. But a lot of people will say, I've kind of outgrown, they've been with me for a while, but I've kind of drugged them up rather than them supporting me the way that I've gotten and the sophistication that I have now. And so we can recommend you to people that know what we do, and you're not having to pay them to get educated on how to handle these kinds of structures.
Yeah, excellent. I mean, for our listeners, right? I think we cannot stress it enough, and we have that discussion all the time. Particularly when someone is a real estate investor. There are great CPAs out there that are excellent in corporate accounting, but they are not necessarily great in real estate accounting. There are also CPAs that are great in oil and gas, but not that great in real estate, and vice versa. So it's really important that CPA understands that particular field their client is active in, and obviously they need to fully understand what you are doing and recommending, so that the accounting piece and ultimately the tax filing piece is all smoothly integrated, so that there are no hiccups on one side, but also that all the deductions are properly accounted for and not lost, right? So
that's where the rubber meets the road. And forgetting a piece or not recommending something that can really dramatically change the tax consequences is so important.
Yeah, absolutely. All right, Kevin, all great information. Really appreciate that that you took your time to explain. I know it's compared to talking about deals and taking down deals and closing on deals, it's not sounding too exciting, right? But it's an important piece to protect whatever one is building. So I hope our listeners take value from our discussion today. How are our listeners able to reach you, Kevin?
Yes. Well, my office number at Tresp Law is 858-755-6672, 858-755-6672, or they can email me at kevin@tresp-day-law, and that's TRESP day, DAY.com. And we can either set up an appointment, or we can send you out, education material. That's my primary job is educating, because then you have a good client.
Yeah, very good. Yes, so you have produced some excellent white papers, right? That outline some of the protections that are available, and I would say that is probably the best first step, right?
Yes.
When someone reaches out to you, that they get to know what at the high level, at least, what the options are, so that when you go into detail with them, that they already have the basic understanding. It's not that easy to understand for the layman, right, or laywoman, but that's at least a starting point.
Well, we know the listeners of Peak Financing are already taking care of themselves, and their acuity already has led them to the right path. So yes. I really appreciate you having me on, Anton.
Thanks again, Kevin. Really appreciate you coming on.
Thank you.
Yep. Bye-bye.